This chapter is about two related corners of corporate finance that look clever on paper but can be dangerous in practice. Convertible securities, bonds or preferreds that can be exchanged for common stock, and stock option warrants, long-dated rights to buy stock at a fixed price. Graham walks through how they're structured, why companies issue them, how they behave in markets, and the traps investors most often fall into. At first glance, convertibles promise the best of both worlds: bond-like protection, interest or fixed dividends, plus upside optionality if the common stock soars. Issuers like them because they can borrow at a lower cost. Investors like them because they get some downside cushion with a stock ticket to the upside. Graham's basic point: you don't get a free lunch. To get the conversion feature, investors usually accept lower yield or weaker seniority. And in practice, convertibles are often issued when markets are hot, late in the bull run, exactly the worst timing for buyers. When the market turns down, the convertibles often fall harder than straight preferreds or bonds because their value is linked to an oft overvalued common. Graham stresses the behavioral dilemma owners face. When the convertible moves up, should you sell the bond, lock a modest profit, or hold and hope for a much bigger gain, which makes you effectively a stockholder? He gives a vivid example. Buyers converted ever-sharp convertibles into stock near a peak and then watched the stock collapse, wiping out gains. The rule of thumb from Old Wall Street: never convert a convertible. Convert only with a very disciplined reason, because conversion removes your downside cushion. Practical arithmetic point: a consistent policy of selling convertibles at, say, 25 to 30% gains often beats trying to catch the top, because many convertibles fail to make huge moves and many collapse in bear markets. Convertibles and warrants can materially dilute future earnings per share. Management sometimes floats convertibles or warrants in mergers or acquisitions, which may temporarily boost reported earnings but can reduce per-share economics when convertibles are exercised. Investors often ignore this dilution. Graham recommends quantifying the fully diluted EPS by assuming conversion and adjusting price/earnings ratios accordingly. Graham is blunt. He considers the modern proliferation of long-dated warrants as close to a financial fraud. Warrants create lots of paper value out of thin air, reduce the intrinsic value of shares. They're a claim on future stock that dilutes originals, and are often bundled into packages to make new offerings look better. He recommends treating warrants skeptically. If a company issues large warrant packages, it's usually a sign of a top-heavy capital structure and a red flag. Two practical adjustments for analysts if warrants exist: add the market value of outstanding warrants to the common equity capitalization. For example, treat them as if they were a claim on equity, or assume proceeds from warrant exercise retire-related debt. But this often understates the true dilution. Graham's verdict: small warrants attached to a bond are tolerable. Massive warrant programs are dangerous. The commentary updates Graham with later market data and practice. Convertibles increasingly behave more like stocks than bonds. In many periods, their returns correlate strongly with the stock market, not with treasury or corporate bonds. Structure has improved since Graham's time. Many modern convertibles are shorter dated, carry call protection, and a bigger share are investment grade, all of which reduce the extreme volatility he saw. For ordinary investors who want convertible exposure, a low-cost diversified convertible fund is often a better option than buying single convertibles. Diversification and professional management mitigate the timing and selection risks. Practical rules of thumb: be skeptical of newly issued convertibles late in a bull market. They often mask weak fundamentals. Quantify dilution: calculate fully diluted shares and adjusted EPS or PE before making judgments. Have an exit rule for convertibles. For example, sell after a disciplined gain, rather than hope to catch the big upside. Avoid huge warrant packages. Treat units that bundle stock plus warrants as suspect unless you can model the dilution. If you like convertible exposure but lack deep experience, use a diversified convertible fund rather than individual issues. Never convert just because the stock has climbed. Conversion should follow a reasoned calculation, not euphoria. To conclude, convertibles and warrants are clever financing tools that can be useful in specific, well-understood circumstances, but they quickly become traps when issued in frothy markets or in large quantities. Graham's message is prudence. Look behind the shiny optionality, quantify dilution, control your emotions, have exit rules, and prefer diversified, transparent ways to get exposure if you aren't a specialist.